Today, is it déjà vu all over again? Hi again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, with bond yields surging back to levels not seen since 2016 in recent months, there's been no shortage of comparisons between the current state of markets and that on the eve of the global financial crisis. And it's no surprise that markets would become fixated on the fact that the 10-year yield, which surged above 5%, has not been that high since October 2007. The global financial crisis, which got underway just months later, is seared into the brains of investors around the world, and every echo of that time is deemed newsworthy. So how striking are the parallels drawn between conditions now and in 2007? Well, perhaps the best analysis came from JP Morgan, who dug out a note published in January 2007 written by Edward Marian, a fixed income strategist at the bank at the time. Marian argued that markets were going through three distinct and dangerous phases that look strikingly similar to what's playing out now. In the first, the Fed raised rates to 5.25% in June 2007, despite many economists suggesting that the last increase was overkill. When it then became clear that the Fed had paused, equity markets went on a tear, hitting a new all-time high in October 2007. But the economy was slowing and investors were betting heavily that the Fed would soon be cutting rates. Marian called this the denial phase. And in the second phase, the economy proved more resilient than expected despite higher rates. Investors gave up on rapid rate cuts and instead bought into a Goldilocks soft landing scenario. Economic growth was solid, housing stabilized, earnings fell, but didn't crack, and equities traded at full valuations with low volatility. Marian called this the head fake phase. Everything feels too good to be true because, well, it is. Marian also predicted the third and dangerous phase. Inflation would prove stickier or even resurgent, and the Fed would talk hawkishly about the potential for rate hikes. Some investors would take note. Others stubbornly would cling to the view that housing, the consumer, and high leverage in the system will be legitimate excuses for the Fed to hold off. And he predicted the Fed would raise rates regardless and risk assets would undergo a big correction. Now, he was slightly off. The Fed was indeed cutting rates by September 2007, but by then it was all too late. Nevertheless, the three phases Marian outlined are remarkably similar to what is playing out now. We've had the big series of rate rises and the grumbles about overkill. We've had the hype in the markets, which are being recently driven, of course, by AI. And we've seen the widespread predictions of rate cuts and the acceptance that those cuts aren't coming, with consensus shifting rapidly to a soft landing. We've even had housing stabilizing, equity markets trading at full values with remarkably little volatility. But now we seem to be entering Marian's third phase. Inflation is sticky and even resurgent, thanks in part to a 30% spike in oil prices since late June, and the Fed and the Reserve Bank of Australia continue to talk hawkishly. Just this week, strong local inflation data has caused debate about the potential for one more rate rise to intensify. Which leads to the obvious question, well, are we heading for a 2007 style correction? There are, of course, some key differences between today and 2007. The global banking system is perhaps stronger. The US housing market is not in such a dangerous state. In Australia, corporate balance sheets are much stronger. But then there are new worries too. Geopolitics are much more tense. Climate change has worsened. The population is older. Perhaps more importantly, debt levels have doubled and government debt is surging after the pandemic. Indeed, a key driver of the recent rise in bond yields is the concern that the supply of bonds needed to fund governments will require high interest rates to attract buyers. It's for this reason that the legendary hedge fund investor Ray Dalio declared recently the US was going to have a debt crisis in this country. Now, Macquarie's strategy Victor Shivets has long been of the view that the world is too indebted for central banks and governments to turn off the policy support that has been expected since the GFC. So he expects central banks will need to cut rates sooner and harder than the markets think, leading to a return to the low-growth world of secular stagnation that we've seen since the global financial crisis, albeit one characterised with low growth and sudden ugly bursts of volatility. But the surge in the 10-year bond yield from 3.8% to more than 5% in 2 months has Shivets fearing the Fed has made a policy error. Giving rates are rising in a US economy, he says, that is clearly cooling. So he expects the Fed to pivot, but now wonders how much damage could be done before that happens. Given that the US is leveraged about 4-1 and that the financial economy is at least 5 times the GDP, the answer is there is plenty of risk. Simultaneous falls of bonds and equities could hit parity trades. The sort of asset mismatches we saw in the collapse of Silicon Valley Bank could return, and with mortgage rates in the US at around 8%, both sides, the sell and the buy, of the real estate market could completely freeze. Pockets of the economy that have less transparency could indeed be in trouble, such as private equity, and particularly private credit provided by hedge funds, which has been increasingly important given the banks have backed away from commercial lending. And as in the GFC, trust between banks could suddenly evaporate, while a move up in the US dollar could sap global liquidity at the wrong time. So this is a decisive and dangerous period for investors. If there's one bright spot, though, it could come from JP Morgan, who points out that at least investors can extract solid returns from cash right now. And as recently been pointed out, for all the similarities, a consensus belief in a soft landing despite hawkish central banks, resurgent inflation, resilient equity markets, housing markets stabilising and accelerating, there are some key differences. The banking system is somewhat safer, and corporate debt levels are actually much lower, particularly in Australia. But as the ASX continues to wobble amid rising geopolitical tensions, it's now dropped significantly from last week. It's worth noting that, in fact, the index is now sitting roughly where it was in the start of November 2007. Now, that's a simplistic measure, of course, because it doesn't include dividends and ignores the fact that over 10 years and 20 years investors are sitting on gains of 109% and 27%. But amid all those nasty GFC flashbacks, the Australian market's performance in the past 16 years is a reminder that local investors have basically seen a long leap sideways since the eve of the Great Recession. Of course, there's not much to lift sentiment right now as local traders wake up each morning to the toxic cocktail from Wall Street and the mess in the US political system. Bonds yields continue to rise, with the benchmark 10-year Treasury again above 5% briefly. And second, the risks from the conflict in the Middle East keep escalating, with markets petrified that Iran will be drawn into the fray. And while geopolitical turmoil tends to weigh on bond yields, concerns that a resilient economy will force the US Federal Reserve to keep interest rates higher for longer in a debt-laden US economy means bond traders just keep selling. Remember, of course, bond prices move in the opposite direction to bond yields. So it's taken a while, but equity investors have also got the message that they're in a sticky situation. The Australian market has fallen more than 8% since the start of August, while Wall Street's S&P 500 index is down close to the same amount. That puts the S&P 500 within spitting distance of 4,200 points, which is widely viewed as the key level of technical support for Wall Street heading into Christmas. If the market breaks below that level, which is close on its 200-day moving average, the fear is that it could keep going. And one of the biggest bears on Wall Street, Bank of America's strategist Michael Harnett, is among the many watching the 4,200 mark closely. He believes investors are now sufficiently bearish for the market to hold at that level for the next 3 or 4 weeks, pointing out that the Bank of America's bull and bear indicator dropped to a level classified as extremely bearish recently. The indicator has reached the level 20 times since 2022, and on average 3 months later US stocks have been 5.4% higher and global stocks have risen 7.6%. So to be clear, Harnett remains bearish, suggesting investors nibble, rent, don't gorge on stocks, he says. Rallies should be sold, and oil rallying beyond $100 US a barrel, or the US 10-year rising above 5%, would likely end any late year rally. And with a characteristic burst of pessimism, Harnett says if the S&P 500 can't hold on to 4,200 with this level of bearishness, then there may be imminent risks of a credit event or hard landing ahead. So the next few months could certainly be telling, but if you stand back, perhaps the ASX investors should think about the bigger picture. Despite all that's happened in the past 15 years, the global financial crisis and the recovery, the pandemic and recovery, actually, they don't have much to show for it. Worth thinking about in the current environment as risks continue to build. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.